Yeah, hello everyone. Hope all of you are doing well. Let me start by wishing all of you a very happy new year and a year full of success, happiness, and good health. Thanks for joining us today on the first webinar from Mirae Asset side for 2026. We have a power pack team to decipher the outlook for various asset classes: equity, fixed income, gold, silver, and international market in today's session. The idea of today's session is to give you a glimpse of how 2025 actually planned out and what should be the approach for investing in 2026. 2025 was a very challenging year for markets and investors. 2025 was marked with a lot of global uncertainty, with tariff issues, but India stood out very strong as a country in 2025. Um, Some of the asset classes gave, I would say, divergence in the returns in 2025, which is contrary to what a lot of investors and experts would have anticipated during the start of 2025. But 2026 promises to be again an exciting year where Indian markets would sort of continue the growth momentum in the year ahead. I am very pleased to announce that I have with me Gaurav Mishra join me for today's first session, which is to discuss and decipher the equity market outlook. Gaurav has about 28 years of experience in fund management and has been associated with the firm for more than 6 years. Gaurav heads the equity function for the AMC, and he manages our flagship product, Mirae Asset Large Cap Fund, and also manages the focused fund. Gaurav, we've seen that markets had a very whirlwind period during 2025, and so did the Indian economy. So what we would request you to do is decipher how the economy and markets panned out during this period. So let me start with the first question for you, Gaurav. Can you give an update on how the domestic economy faced 2025 on various macroeconomic parameters, and what do you think were the hits and misses for the Indian economy for 2025?
Yeah, good afternoon, Vaibhav, and Happy New Year to you and a Happy New Year to everyone. I will start in the manner you have asked. So clearly, 2025 was a very interesting year, frankly. But to put it in context, in the past few years, we have seen that the Indian macros have got stress tested on many occasions.
Sure.
A few years back, it was the the COVID crisis,
Correct.
then it was the Russia-Ukraine war,
Yes.
and then last year, of course, the tariff challenges. And the macros have always, held up despite all these vagaries. And last year really was no different in that sense, that
Sure.
despite the ratcheting up of tariffs as the year went by from, the much lower expectations to 25 to 50.
Correct.
As the year actually went by, the real GDP growth for the country actually, picked up and surprised actually, yes, on the upside.
Correct.
Similarly, despite concerns on, maybe the impact of tariffs on global inflation and all that, but clearly in India, we saw that inflation actually kept on inching downwards and again surprised positively in that sense. And then all of that gave, room to the monetary policy and monetary authorities to be more accommodative, and we saw rate cuts continue right to the end of the year, and possibly we could still see some more support
In 2026.
yes in 26 as well on that front. So clearly there was a lot of the macros in that sense were supported by good real growth, a benign inflation and interest rate environment, and underlying all this has been policy support both on the fiscal front and on the monetary front, and we really have to see how that further supports growth in 2026. So whether it is the and we're seeing early signs of the revival in the credit cycle,
Sure.
in the real estate cycle, which was in a sort of consolidation phase, but I would still think that there is more legs there. Similarly, we saw post the GST that autos have picked up, but this could well spread out to other parts of the discretionary consumption. So a lot of things to be looking forward to in 2026 and how they play out. Similarly, on the deficit front and how the government, and I'll come to the second part of your question, which is really on some of the misses.
Correct.
So what looked like a miss as the year went by was really the tax collections and the revenue collections for the government of India. They were falling short, but we have to keep in mind that uh, there was the direct tax cut in the budget at the
Correct.
start of the year, and then the GST cut. So obviously,
Correct.
there was going to
There
be
would
an
have
impact.
been an
Yeah, there
impact.
would have been an impact. What has to be seen is the elasticity
Correct.
of the of demand, especially on the indirect tax front, and we're seing signs of that as the year was closing, that GST collections were again starting to pick up. So that we have to see, but net net, if there was a weak spot in the macro, it was just the overhang of how the fiscal would hold up till the end of the year.
And how
But
about the currency, Gaurav?
yeah, no, so I'll come to the currency, but I'll just conclude by saying that I'm not really too concerned on the fiscal front also, because
Sure.
the government has leeway to to also hold back some of their expenses such that they still meet their targets, and therefore I will say that on those parameters it's kind of taken, it shouldn't be a problem
Sure.
for the year gone by. Now, on currency, yes, no doubt, India was a bit more on the receiving end. Of course, the DXY itself was, has weakened in this period.
Correct. Correct.
Uh, India may be a bit more so. I think, when we put the economy in context of the tariff environment, where we are at 50%, and a lot of neighboring countries in the region are more at 15 to 20%, it does put some of our exporting industries
Correct.
at a great disadvantage. So in that sense, it's all right if there's been that little bit of um, relaxation there,
Sure.
to support exporters. Otherwise, if you think of the fundamentals, frankly, the given the low inflation and the low inflation and interest rate differential between, especially on the inflation differential between,
Correct.
big economies like US, this sort of depreciation should not sustain. Okay, it's more these flow-related, challenges short
Challenges.
term, which have caused this. So I'll not, and then again, as I was saying, that it supports the exporters as well. So I will, think that it's not a disruption or doesn't point to any major further deterioration in Indian macros.
Sure. So, coming from the sort of macroeconomic environment, Gaurav, last year was a very interesting year for markets. So, Nifty for the 10th consecutive year gave positive returns, and Nifty was up 10%. However, if you see the broader market, it sort of underperformed quite significantly. So, about 60% of the top 500 companies delivered negative returns. The mid and the small cap segment, which was the darling of the market, uh, in 2023-24, had a tougher time during 2025. Though mid caps ended, the year with a 5% gain, small cap index still was down 7%. So if you look back on 2025, how do you think various market segments have performed? How was the earnings season for 2025? And which segment of the market you thought did better than some of the other sectors?
Sure. Yeah, I mean, you're right. The headline indices did move in that sort of dispersed manner, and India clearly did not, even for the Nifty, was not amongst the top performing markets in the global scheme
Correct.
of things. But we have to keep in mind that at the start of the year, 2025, Indian valuations were also at the higher end across categories, whether it was the small, mid, and also for large, maybe not to that extent. So there was that uh, time correction which was required. In any case, it's not like earnings were very strong, and I'll come to
Correct.
that as the year progressed. Um, but sure, markets, you know, might have given modest returns or negative in the case of small cap, but I would also step back a bit and say the markets were still very healthy. So
Sure.
it was a very a market where you had huge selling by the FIs. I think in fact they've sold close to their highest 19-20 billion USD, which is the highest ever since
Correct.
they've been
Correct.
in Indian markets, and whereas the domestic funds were buyers.
Bias.
Yeah, so in that sense, and as the year went by, a one-sided market. It was a
Hmm.
healthy market where, there were divergent sort of actions happening. And so where we are now, also the valuations, since there's been a bit of a time correction, in that sense, the markets are healthy. Then I won't be concerned at an aggregate as well.
Sure.
But yes, to your question, whether or rather what performed well, okay, there were some sectors in any year. So last year we've had the metals pack, which did well. We of course had the auto, which kind of
Energy and
got a
utilities.
yes got a tailwind there. Then also select financials, including the NBFCs,
Correct.
the non-lending financials did better, than just the banks per se,
Sure.
in the year gone by. Amongst the weaker sectors where, utilities, IT for, various reasons
Correct.
didn't do, too well. So yeah, I mean, there were the usual, some weak spots. If I took the name of utilities, that was one which also didn't do too well last year. Real estate was another sector. Um, when I think of where we are now in terms of the outlook,
Sure.
I'm still, more comfortable as a starting point, unlike, say, 2025 across different, market caps. It's a separate matter that the markets might consolidate for a while more, and there might be certain category which might, be a bit more rewarding for a while.
Sure.
And that will really be a function to your other question on the earnings growth outlook. So, we have seen earnings, dropping quite a bit as the year progressed. So nominal growth at the
Correct.
economy level was much weaker than what we might have thought at the start. So
I
while
think
real growth was healthy, 7% plus, but nominal growth was, not crossing that 10% level. I think that also had a bearing on just corporate top line growth, and how it,
other market.
yeah, and how it, kind of fell down. I mean, slipped into the earnings,
Correct.
from top line to the earnings. But I think that base is now formed in terms of inflation being as, low as it can get.
Sure.
It'll just pick up a bit more. So I would think on a top down basis also, nominal growth should pick up for the system, and therefore corporates will benefit from that. And as we saw in the result seasons during the course of the year, uh, that towards the second half, earnings growth has picked up. The cut to earnings have been, lesser than what they were at the start of the year.
Sure.
One big part of the market, the BFSI, the banking space,
Hmm.
that typically, when there's a rate cut,
Correct.
initially there's a pressure on margins, and it's a big part of the profit pool, etc. So
Correct.
that was pulling down earnings for the first 1 or 2 quarters, but now that will more or less come into the base. And in fact, I would think that, that sector, for instance, should
Should
have
do.
much more robust earnings growth going into next year. So I would say that yes, earnings where, there were cuts. We are probably looking at FY26, or, this calendar year 25 period as being of a single digit earnings growth, but it does and should improve into next year.
Sure. How do you see that domestic flows have been able to negate the strong FI outflow that we've seen in 2025? And how do you think 2026 will look from both earnings point of view, flows perspective, and overall valuation perspective as well?
Okay, so as I was saying, that the macros are stable, and there are some cycles in the backdrop which are in the signs stages, early stages and stage of picking up.
Sure.
Now we have to watch for how those play out. I would think that some of them will definitely play out. For instance, the credit cycle.
Hmm.
We're already seeing sequentially month on month that there's a pickup in credit demand.
Hmm.
I think it should inch up a bit more, and
Okay.
that will be supportive to, say, banking sector and the whole BFSI space as well. Um, Similarly, the auto space, we've already seen that pickup, but with all the tax cuts and, the support, should maybe we do see a spillover into other discretionary consumption as well.
Sure.
So these are, the banks are a big part of the profit pool.
Correct. Correct.
Consumption itself, across from, if you think of discretionary all the way to staples, is also a reasonable part. And with autos included, where we already seen pickup, it should also further support earnings. Then There are smaller parts, but again, where the cycles could be, holding up, like real estate, and they should also then have a multiplier effect. So I have, comfort that where we are right now, the next, 4 quarters should start seeing earnings growth get into back into the double digit, both from a macro, nominal growth support, then from the cycles which are, also supportive across big parts of the economy. Then yes, there's a big sector like IT, which has been, under the weather for the
Yeah,
last 2-3 years.
correct.
We can go into that, but right now, consensus is still single digit. Maybe it requires some more tailwind really. So I'll not, be too
Positive.
positive on that. I'll be neutral at this stage, but we have to, see how that goes. And on the other hand, the whole infra capex. No doubt, the government's been withdrawing, from the support they were giving post COVID, but uh, they were so far targeting huge reductions in fiscal deficit to GDP, and
Correct.
yes, and that was the case for the last 2-3 years. So there was that contractionary impulse in the economy. I think now that will start waning off, meaning that maybe from this budget we have to see, but they could well be targeting the government debt levels to GDP of in
Okay.
that 50% by FY 30-31. So therefore the contraction on fiscal deficit might be lower
Lower.
than what we have seen,
Correct.
and so that might give them some leeway to support infra growth as well.
Infrastructure.
But we have to see. So a lot of things, as I was saying at the start, that a lot of things to watch out for. Nothing's on the paper or cast in stone. A lot of variables across key parts of the economy, including capex for that matter. Because as the year went by, FY last year, calendar year 25, we have also seen a pickup in announcements by private sector or on capex projects.
Sure.
So if that's were to sustain, that could also be further supportive. So yeah, it's there's comfort on one or two cycles like the credit offtake,
Sure.
and hopefully some spillover into of consumption across other categories besides auto. And bottom up, when we see earnings projections by analysts, there is that comfort that we should be getting back into the double digit for the next year.
So in that context, Gaurav, what would be your top three overweight sectors and top three underweight sectors?
Yeah, no, but see, I mean, as I was saying, that this is a very fluid situation right now,
Sure.
in terms of where that growth will, really come by. And additionally, then we have to keep in mind the starting valuation.
Sure.
So we'll really have to be a bit flexible and agile as we go along. But some big sectors where there is comfort both on valuation and also for earnings is one big sector is, for instance, the banking. So there, of
Sure.
course, appropriate
Right.
stock selection will help. Uh, then others are saying there's a whole host. Autos, we're already there, but it's in the valuations. There can still be some compounding to be had in that space. Um, then, in terms of other smaller sectors, I still think that there'll be reasonable earnings trajectory in, say, telecom,
Perfect.
as we go ahead. So, in a lot of these spaces, we're already there and would like to, participate. In areas of um, then there'll be some sectors where, like real estate, which could well see a strong,
Yeah, they
yeah,
went through pain
yeah,
in
they've
this.
been through a kind of consolidation. They
Correct.
underperformed the whole of last year.
Correct.
As I'm saying, I don't think the cycle is over. Maybe there is some sort of tailwind which comes back in that. After all, rates are being cut, the environment
Correct.
is supportive. Some of them are, of course, smaller sectors, but there are linkages, etc., for the rest of the economy. So, enough reasons uh, to to look around for ideas
Sure.
across. So these are a couple of sectors top down, but as I'm saying, there's enough across other sectors where bottom up in consumer discretionary, in some staple names, where there could be a tailwind, and if chosen correct, there could be some stocks which benefit, which we have identified, which are in in the portfolio. But I mean, it'll be then more bottom up, I would think, for the year ahead.
Sure. Gaurav, I think overall 2025 was a good year for Mirae equities funds. I think most of the funds were in quartile one, bounced back very strongly 2025. If we were to look at allocations for 2026, I know it's a tough one, but like we said, 2025 large cap outperformed mid and small. In the past, mid and small cap outperformed. Given a choice of how you would allocate, how would your allocation be between large, mid, and small? And what categories do you think are best suited for investors to take access of investing in markets in the way markets are behaving with a sort of a 3-year plus window?
Mhm. No, sure. And before I answer that, I'll also like to just step back a bit. See, I mean, and a lesson we have been learning every year is just the sheer volatility in the markets, and which often comes from, things we do not imagine at the start of the year. But as we sit here, it's clear that there is enough geopolitical pressure in the world. Countries are economically interdependent, and yet the bigger countries are trying to, seek economic security, and
Correct.
all that, process is causing its own friction,
Absolutely.
and could well lead to wars here and there, and we are seeing signs of that. So in that context, first of all, for investors, it's important to have a diversified asset allocation. So
Sure.
just a step above equities, but to be diversified across appropriate asset classes.
Sure.
Then coming to equities itself, of course, I'm a strong believer in the power of compounding, and I think equity investors should be looking at this asset class with a medium to
Longer term.
long term horizon. So which is the 3-year
Correct.
horizon. That's I think where the benefit of power of compounding, etc., is captured in
Correct.
portfolios. Uh, Having said this, I think for investors, uh, of course, I mean, over a 1 year, yes, but definitely over a 3-year period. When we think of the India story, as we are, discussing that, hopefully the growth trajectory on the earnings front should improve next year versus what we have had in the past 1 year. Um, then there's additionally a structural story to element to the India opportunity on various fronts. That's well
Sure.
known. I'll not repeat that. But so when you keep that in mind, you realize that across any particular market cap, the large, mid, or small, that opportunity set is not given justice if you have to stick to just one.
One
There
segment.
there are enough industries which are profitable, high growth, which might not be part of the large
Large
cap
cap
because those
index
industries are small. So the leading firms in those industries
could be mid or small.
could be mid or small. So a lot of capital goods name actually fall in the mid small.
Correct.
Even in the hospital space, except one or two, they fall in the lower
Correct.
hospitality and so on. So there's a
Correct.
and vice versa. There's some industries, say the big, the banking. So where as the economy grows, the bigger banks can,
Benefit.
if they do a good job, they participate, and therefore they already are part of big. Or even
Correct.
commodities, the big names, because it's a global play.
Correct.
So there's therefore a need for investors to be represented across all these cohorts, the large, the mid, and small. And stock selection is important, and this is especially over a 3-year horizon. So I would think that right now, just because there's a bit of doubt on the earnings revival, um, and there is the additional headwind of the tariff issue,
Tariff issue.
and it's clearly going to be hitting a few sectors the longer it kind of prolongs. So in that sense, maybe right now there is safety in slightly bigger businesses and more domestic facing, where in the large cap you get enough of those. But with a 3-year horizon, I would think that a combination of large cap, a mid and a small cap is good. And if the small cap, for instance, were to correct a bit more, then one can look to enhance weights.
Incrementally.
Yes, yes. In that, I'll not give. I can give percentages. I would think at least 40, 45 should be in large, similar in the mid, the rest in small. But if the divergence, if this large were to do better, say for the next 3-6 months, then somewhere there'll be scope to
Enhance
reallocate back
between
towards small, yeah,
mid.
between mid towards mid and small. That's one way to do it, individually, if an investor wants to attempt that. The other easier way is to, go through our multi-cap offerings, which give you that
Correct.
minimum allocation of 25, 25, 25 across the three, and then with a slightly bigger bias towards the large. So
Yeah.
that over a 3-year period, you anyway got the benefit
Correct.
of, the whole system growth, the whole
Correct.
corporate sector.
So large and mid cap or multi cap
Yeah, yeah,
sort of
yeah.
products, or investors can take
Yeah, take this
direct
call of direct
exposure.
to large middens.
Fair. Thanks, Gaurav, for sharing your perspective on market sectors that you can be looking at, and the fund categories that we can look at investing. And hopefully 2026 is a much better year for equity investors than what we saw in 2025. Lastly, I'm now very pleased to introduce that we have a new segment that we would want to talk about, which is on the fixed income side of the business. And I'm very happy to introduce our next speaker, Mr. Basant Bafna. Basant has more than 14 years of experience, and he has been recently elevated as head of fixed income for our AMC. 2025 was a very interesting year where RBI continued its rate cut cycle, and not only it had a very aggressive rate cut cycle for the last couple of years, but it also enhanced the liquidity for market quite a lot. The Fed also started rate cut cycle in the calendar year 2025. As we said, head into 2026, there must be a lot of confusion in investors' mind that how should they approach investing debt, and which other categories in fixed income that we could look at investing in. And we don't have a better person than Basan to sort of decipher on which which segments of the fixed income market that they should look at investing. So welcome, Basan, for today's webinar. Uh, Basan, maybe before we head into how investors should invest and how they should approach investing in 2025, 26, 2025 was a very interesting year for both Indian debt markets as well as the global debt markets. And we saw huge volatility across both these markets. Can you share maybe the key highlights of how you saw the fixed income market pan out in 2025?
Sure. Thanks, Vaibhav, and happy to be here. So 2025, as you alluded to, was a year of rate cuts, and we'd seen rate cuts across economies, be it emerging markets or developed markets. Along with that, we saw that inflation also from the sort of post-COVID era and shocks relating to the Russia-Ukraine situation. So from there, we've seen that inflation has also started falling, but it still remained elevated for advanced economies at above target levels. Growth surprisingly has been very resilient. Over the last year, the year prior to the last year, we've been speaking about the probabilities of recessions going into 2025 for the US, and the growth has surprisingly been very, very resilient. But with the rate cuts, have the rate cuts translated to a parallel shift in the yield curve across segments? Perhaps no. And the reasons are different for different economies. So for example, for US, there has been fiscal concerns around what's happening in the US. Apart from that, there has been a steepening of the yield curve wherein rate cuts have translated to transmission in the shorter end of the yield curve, but the longer end has remained elevated. So from that perspective, we've had challenges in terms of a very steep yield curve, and broadly, I mean, we've also seen a bit of shift in terms of geopolitics from debt markets towards equity, towards commodities. We've seen how precious metals have performed across last year. Domestically, it's been similar in the sense that yield curves have steepened significantly, but the situation and reasons for that have been different. So in the longer end of the curve, we've had issues relating to demand versus supply. Demand has been muted primarily on account of front loading of demand at the beginning of the year, and front loading of rate cuts by the RBI, which was incur more and more of FX intervention. But I think that will be something that will be a large part playing out over the next year, depending on how the flows evolve. And as Gaurav alluded to, given that equity is expected to sort of be in positive direction for the rest of the year, with that you should start seeing FPI flows also come in. The index inclusion flows will of course be biased towards appreciating currency and would help RBI to sort of increase their buffers in terms of FX reserves. So along with that, along with a positive outlook on equity, the interventions may not be as significant as it has happened in the last year.
So Basant, I know overall in the debt market, I know largest question investors have is which segment of the market they should invest in, right? So I know in the previous sort of conversations that we've had, And our view that we've also shared with partners is, the shorter end of the curve always looked sort of more attractive. Considering that, we've seen significant rate cuts and liquidity now also is sort of being added into the system. Which part of the yield curve you believe is most attractive at this juncture? And in your view, what should be the segments investors should look at for investing with maybe a 2 or 3 year sort of perspective?
Sure. If you look at the curve is significantly steep up to 3-year segment, and from there on it starts flattening. So the 3 cross 5 is sort of 10 basis points. That's about it. And if you look at the overnight rates, which are hovering in the range of 5.1% thereabouts, versus the 3-year rates, which are closer to 7% now,
Correct.
697, 698 sort of levels. So the spread is almost, 190 basis points.
Yeah, quite meaningful.
Which is quite meaningful from an investor standpoint. So from that perspective, we like the 1 to 3 year segment the most, with liquidity driven rally to impact this part of the curve the most. The longer end of the curve continues to be impacted on account of very high SDL supply and the demand supply mismatch which continues. There might be some respite on account of the index inclusion announcements, but the risk reward is significantly higher in the 1 to 3 year segment, and that's why we like that segment the most. But apart from that, we've seen, so from the start of the rate action cycle by RBI in 2025, the longer end yields have actually moved higher as compared to the shorter end. As compared to what the yields were at the beginning of the rate cut cycle.
Sure.
Now, if you put that in perspective, as against your inflation, which is expected to remain closer to 4%, remain anchored for a foreseeable future. From that perspective, and oil prices remaining benign despite what's happening geopolitically, with OPEC continuing to support oil prices, with that you hardly have any sovereign instrument which beats inflation over a long period of time.
Correct.
By more than 3.5%. Right. So from a real investor perspective, and from the perspective that we are a 28-year median economy, with median age economy, with contributions continuing to accrue to insurance companies, pension funds, provident funds, and would continue over the foreseeable future, there will be a continued appetite for longer end papers for the foreseeable future. We have a demand supply mismatch right now, and we've seen that a large part of funds
look on fixed income market. And I must congratulate the entire fixed income team for, for the last many years, we've seen that we've been able to manage fixed income AUM quite consistently. Performance has been quite stable. And in spite of a lot of credit issues that we've seen in many other funds, Mirae has sort of managed portfolios, very clean portfolios, very well. And that's why if you can see our debt AUM is sort of over the last 4-5 years has actually grown 10 times. So congratulations to you, Basant, and the entire team. And hopefully investors get a good experience of fixed income products in 2026. So thanks, Basant.
Thanks, Vaibhav.
I'm also very happy to introduce our next speaker for today, Mr. Siddharth Srivastav. Siddharth has over 15 years of experience and currently heads ETF products. Siddharth manages overseas products for the AMC. And also what we want to do is put Siddharth in the spot by asking him views on various asset classes, especially commodities, which is gold and silver, and also cover on outlook for international markets like US and China. So welcome, Siddharth, for today's session. Siddharth, let me ask with the first question, that we saw 2025 as a year of precious metals. If we saw that gold was up 70% and it did exceedingly well, silver sort of surprised everyone with a 130% sort of rally. And large sort of investment quantums are now being allocated by investors into gold and silver. Maybe if you can help decipher what happened in 2025, which led to the strong sort of performance from precious metals, especially gold and silver.
Thank you for asking that question first, because I think that is the most asked question and last. 3-4 months, I guess.
Absolutely.
Yeah. So let's first talk about gold. So in gold, we have seen central bank demand continuously increasing in last 3 years. So if I talk about 22, 23, 24, central banks in aggregate bought almost 1,000 tons
Wow.
every year. Uh, and that is significant because if you look 8 years before that, their purchase were in the order of 400 to 500 tons. So it was almost meaningful increase. Even this year, when gold demand is, we expected sorts of to mute from central bank point of view, they are projected to purchase around 900 tons this year also.
This year, at these levels.
At these levels also. In fact, what we are seeing is that there are newer central bank, apart from the usual suspects like China, India, etc., who are coming up and buying gold bars. I think de-dollarization, especially what happened when Russia-Ukraine war started, and the way in which Russian assets were confiscated, right? That has alerted a lot of countries, and that is why we are seeing a significant rush to diversify holdings at central bank level.
Forex holdings.
Exactly. And I think that will continue for coming years. So I think that demand is something which is in a way stabilizing gold prices also.
Okay.
Even at these levels, I don't expect significant correction in gold prices because I think central bank demand will continue. Second thing, what happened was that once this buying started, people started seeing that that gold prices are running up. People have started investing in ETFs and bars and coins.
Correct.
So you'll find it surprising that in 2023, there was a net outflow from gold ETF to a tune of 240 tons.
Oh.
Outflow.
Outflow.
Even in 2024, there was an outflow of 6 tons.
Okay.
This year, in first 3 quarters, there's a net inflow of 618 tons.
Wow.
I'm talking about globally.
Correct.
So just imagine from minus 240
tons
in 2023, you are now at 618 ton, almost, let's say, equivalent to what central banks are buying, right?
Correct.
So that is also something which has created this huge demand for gold. And that has also propped up the prices of gold in a reasonable manner. Now, so people typically also look at gold silver ratio when they invest in gold and silver. So gold silver ratio touched high of almost 104, and this is in April this year.
Okay.
Last year, sorry, now. And the long-term average since 1998 was around 68.
Correct.
So people started looking at silver that this is undervalued and underperformed. They started looking at silver as an opportunity. So it's not as if that silver key demand in green energy, in photovoltaic cells, in EVs have been discovered now. It has been in deficit. Yeah. 2025 is the 5th year when it was in deficit. Silver demand is around 1.25 billion ounces. Supply is only 1 billion ounce. But then people also looking at silver, that after gold, silver looks very attractive.
Correct.
And then this rally started. People started obviously looking at silver more and more. Demand got inflated also from an investment point of view, to an extent that now we are seeing gold silver ratio at 59. From 105 in April, we are looking at 59 now, 10% lower than
average.
That's below the average. So 2025 has been really amazing for whosoever invested in precious metals, and great for us also because we got so many questions and inflows in funds in both gold as well as silver.
Sure. So, the question that will come to investors' mind, and like you rightly pointed out, maybe during 2023, gold and silver hadn't given great returns from a 1 year, 3 year in one go and lump sum.
Very rightly said. I'm like, if we look at data, it has been proven that more volatile the fund or the asset class, better the SIP performance is. And we are running this gold and silver fund of fund. When we started 3-4 months back, we are more tilted towards silver. And now I think we are doing some amount of profit booking, looking at some tilt towards gold also. But I think that fund is a prudent way to take exposure in both gold and silver, because fund can do the shifting without sorts of invoking a tax incidence at the investor level, right? Because the entire shift and taxation is absorbed in a way. It doesn't get levied at the fund.
Not only taxation, I think the percentage of allocation also can be a big advantage that you can sort of add. So that we've also seen that though Indian market had the 10th consecutive year of positive returns through Nifty, Indian market had actually the huge underperformance to many of the global markets. So, South Korean market was up almost 70%. Many of the emerging markets were sort of up more than 30-40%. So India sort of underperformed quite significantly to some of those markets. And we see, in spite of the sort of negative news flows on AI and technology, huge divergence in the return profile of various markets. We have a lot of overseas funds at Mirae, and you would be tracking some of those markets. Maybe how do you look at the outlook for US market and China market, which are the sort of two leading markets from a global perspective?
That's a great question. I'm like, the only sad part is that SEBI and RBI have not sorts of increased the $7 billion limit. And I think a lot of mutual fund investors have missed this rally, especially in US market and China market. Thankfully, GIFT provides that route. So we have fund there, which is still open. But let's talk about what happened in 2025, right? US market, in a way, from a number point of view, was very different to what we saw in Indian markets, especially from a corporate earning point of view. So GDP numbers have been pretty robust. Recently, Q3 numbers were around 4.3%, Q2 around 3.8%, and this was negative in Q1. So numbers which are coming out at an economy level is quite good. In fact, services PMI is consistently positive, mid-50s. But the most important thing is that corporate earnings are coming out to be really good, which is not happening in India, right? If you look last 4 quarters and ending Q3 2025, we have seen YOY double-digit earning growth in all 4 quarters. In last quarter, almost 83% of companies gave earnings which outperformed or beat the analyst expectations, which is one of the highest, right? 10-year average is somewhere around 76%. 94% of tech companies, we are talking about AI bubble, but 94% of tech companies also outperformed and analyst expectations. And the earnings growth for 2025 is expected to be around 12.3%. So tech performed really well. FANG gave a return of almost 21%. S&P 500 gave a return of almost 18%. Though from a returns point of view, this was a bit narrow from a performance point of view, because if you look at S&P 500 equal weight, that return was almost 11.4%. So market was, in terms of contribution, the market breadth was shallow. But I think all throughout, whenever we thought that markets will correct, you saw earnings coming as a positive surprise. I think that's a very good thing about US markets right now, that earnings are justifying the valuations. Your S&P 500 and NASDAQ is at 25% premium, and it is still looking robust because of earnings. And when you come to China, China was a different case because valuations was at an almost all-time low. Hang Seng moved up by 32%. Hang Seng Tech moved up by almost 24-25%. Even after this move up, Hang Seng valuation is roughly around 12.5. It is significant discount, 40% lower than what US valuations are, much lower than Indian valuations. We are talking about why FIIs are not coming to India, because we don't have earning visibility that much, and we are seeing some amount of recovery happening in China. Also, China industrial production was a positive. Positive was exports also. A lot of it was front loaded to beat the tariffs which US government is imposing. And even export oriented segments and tech oriented segments are positive. I think one drag which continues to remain is property, which is still sorts of not recovered completely. And second one is basically domestic consumer demand. That is still a drag on the overall economy. We are seeing 3% degrowth YOY, and deflation is because of that. But now, in last few months, we are seeing that also sorts of stabilizing across China. So, good year for both the economies, both from the market performance point of view. US continued its journey of delivering good returns, and China seems to be recovering from issue which it itself created 3-4 years back.
So you are sort of still optimistic that both US and Canada, Chinese market should sort of do well.
Yeah. I'm like, people are raising more concern on AI, but I personally believe that this situation is completely different to what happened in during .com, because people are, I don't know why comparing, because these time all these tech companies are very well capitalized. They have a very robust cash flows.
Absolutely.
And earnings are justifying that. So I believe that in US contribution will widen. We'll probably see a larger participation of X Max 7 companies also in S&P 500 from a return contribution point of view. But having said that, I believe that US tech story will continue. In China, I will suggest that invest in segments which are aligned to policy. And policy is talking about invest in tech. AI, semiconductors, etc. So be that side. But broad market also, when I think property markets and domestic consumption stabilizes, broad market should also start doing equally better.
So Siddharth, you touched on AI, you touched on semiconductors. Maybe the last question from my side to you is that what themes do you think are relevant for investors at this perspective from a global perspective? And there are also some interesting players coming in India from thematic perspective. So from a passive products that you have, maybe one or two ideas that you want to share, which you believe can do well from a thematic space as well.
So first I'll say from a global point of view, globally we have a call that AI will continue to do well. We have a wonderful fund called Artificial Intelligence and Technology. Sadly, that's closed. That gives a very diversified exposure to the global AI and semiconductor companies. Now you can access that via Gift City product which we have. It has allocation to that product. Globally, also defense tech is something which we are positive on, and
especially AI, the defense in the sort of geopolitical risk that we run.
Absolutely,
as a globe, defense becomes a very important theme.
And I think the next leg to AI will be AI infrastructure, right? So these are three themes globally we are very bullish on. We have exposure to these themes via Gift City Fund, but people can, if they want to invest separately via LRS route, they can obviously explore that. When it comes to domestic market, I think our in-house call is very positive on BFSI. So we have financial services ETF. We have a call on consumer discretionary. So we have India's only new age consumption ETF, which gives you exposure to just discretionary consumption. And we are sort of positive on metal CTF also, though we feel that it will be volatile. So one should treat it differently than how they are going to trade BFSI and consumer discretionary. Also, just last thing, because we have seen a lot of people investing in smart beta products last 2-3 years. I think because of lack of trend as of now also, I think a diversified factor approach is better. Multi-factor. We have a fund of fund or that, or you can do on your own. Once a trend emerges, then probably you can choose low vol or a momentum and skew towards that factor. Right now, diversified plays is better.
Sure. Yeah, thanks, Siddharth, for sharing your perspective on gold, silver, and outlook for the US and Chinese markets and the themes to sort of look out for 2026. Siddharth sort of gave his perspective on various markets. Also, he quickly just shared that we also have a product in Gift City, which gives investors access to some of these global products which we're not able to access through the mutual fund route. So please go through that on our website to get more details. I'm happy to introduce our last speaker for today, Harshad Borauke. Harshad has over about 21 years of experience with more than 8 years of experience with Mirae. He is head of research and manages our hybrid funds. And I know the most important part of today's discussion is to look at asset allocation. So we covered on various markets. We covered on outlook for India market, Harshad. We covered outlook on debt markets. We covered outlook on gold and silver, and we covered outlook on international markets. And each of the managers gave their perspective on the outlook for 2026.
Sure.
Most importantly, that we've seen that 2025 has taught us that asset allocation remains one of the most important ways for investors to access investing in markets. Maybe at start of 2025, someone would have told that gold and silver will do well. I think very few investors would have betted on gold and silver. They would have actually been overweight on mid caps and small caps, which actually was the worst performing category to invest in. This just brings the importance of asset allocation. Maybe Harshad, from your experience of looking at all the hybrid products and strategies, how important do you think is asset allocation for investors, and what should be the approach investors should look at to ensure that they are sort of well diversified across asset classes?
Sure. Yeah, I think the topic of asset allocation quite interesting. So maybe we can start with why, what leads to the importance of asset allocation. I think clearly from typically you, me, any investor, large investors. So there is a recency bias which creeps in any decision whatever it is. So that's the way if you look at last 3 years particularly, and I think last 3 years is a classic textbook example which shows the importance of asset allocation. So there was a period when mid caps and small caps did very well.
Correct.
There was also a brief period when debt also did very well.
Correct.
And then last year, as you said, gold and silver also did very well. The point is each asset class in the last 3 years has tried and outperformed each other. So in this context, I think clearly the lesson which one can take is that it doesn't really make sense to bet too much on predict the asset returns. What is more prudent, what is more practical, what is more right way is to have a decent asset allocation across the asset classes. So in this context, I think if you look at last, as you said, investors typically look at last 1 year, which we
Correct.
as a mutual fund, we try to advise them to look at the long term, risk return profile. So in that context, I think clearly last 1 year has shown that the returns of an investor would be much better if we had allocated different asset classes. Obviously, the next question for you or one can ask is, what is the right asset allocation for each investor?
You preempted my next question, which is that diversifying into various asset classes is always sort of an answer all of us give to investors. But the problem an investor has is how much to allocate.
Sure.
And how should they sort of decipher on allocation between these various asset classes?
Sure. So I think before coming to exact percentages or range of percentages, let's look at each asset class. What is the underlying returns? What is the underlying risk return profile for each asset class? So from our own discussion point of view, let's start with equity, right?
Sure.
So equity over the long term, at least in India and many large countries, has shown as a good protection against inflation. It's a good compounder over the longer period. The only drawback of the equity, I will not say drawback, but the only characteristic of equity is it tends to be volatile.
Correct.
So while over the period you can make better returns, but volatility is higher in this asset class. Second asset class which comes from the discussion is the debt. So debt, while is a very good asset class because volatility is much lower. The only point out there is the returns from the Indian context can vary between, let's say, 6 to 8.5%. That's a broad range in terms of returns, and debt acts more as a stabilizer
in your portfolio. Third asset class, which is, let's say, I'll club together, precious commodities or gold and silver. So here I think more than returns, the call is more on the asset allocation for this category. Gold, as you know, it's called as store of value, in the sense, it kind of, if you look at last 100 200 years, so it has protected its buying power, right? So to that extent, investing in gold and silver historically and even in future, I believe that it's not about returns, it's more about stability. Whenever things become more volatile on the equity markets, debt markets, geopolitical issues, so this is the metal where every investor flocks to. This is the metal where different central banks
Correct.
flock to. Having said that, in this context, I think then the next thing to look out is what kind of investor you are, right? So typically what we say that we are conservative, you're moderate, or you're aggressive. See, the point is everybody wants return. It's either conservative or aggressive.
Absolutely.
But we classify them based on their risk appetite. Risk appetite in the sense how much volatility they can stomach, what is their time horizon. So that decides whether you are a conservative or aggressive investor. So I think this is a broad range, don't hold me for it. So typically a conservative investor, I would believe that he should have 50 to 60% debt in his portfolio. An aggressive investor can have 20% or lesser as a debt.
Okay.
Commodities, I think gold, silver, for that matter, I think can be, for an aggressive guy can be like 10 11%, for a conservative can be a 15%. And the remaining is equity percentage. So all this, equity for a conservative guy can be, let's say 30% or 35%, and for aggressive person can be like even 70% or so. The next question, which I'm sure, Gaurav would have addressed, how much for large cap, mid cap, and small cap. So within that, I think for a conservative, typically one should have 65 to 70% in large cap, and maybe 20 to 25 to 30% in mid, and the rest in small. Whereas on the on the aggressive side, he can have like a multi-cap fund, 50% in large cap and 25 in mid and small. So that can be the broad ranges for the asset allocation.
Sure. So Arshad, you sort of gave a range of how a conservative to a moderate to an aggressive investor can allocate to various asset classes. This brings to that classical question that you gave the range, but when you as an investor want to do the rebalancing, there are some technical challenges. One is when you see an asset class doing exceedingly well, you don't want to book profits from that asset class. You want to carry on to that asset class, which leads to the allocation weights of that asset class going up significantly. Second is when you rebalance the portfolio, it also creates a tax incident for the investor when he sort of moves out from one asset class and goes to the other. That's where hybrid funds remain a beautiful way to access some of these asset classes. Now you sort of managing most of the hybrid funds from Mirae Asset and heading the research part of it. In your perspective, if someone were to look at hybrid funds as a space, which categories do you think makes most sense for investors in 2026, considering the views that we shared on equity, fixed income, international, gold, silver, etc.? Which categories do you think makes more sense and how they can sort of participate through these hybrid funds?
Sure. Yeah, I think, see, you touched upon an important factor in terms of investing is taxation, right? So while mutual fund obviously is the most tax efficient way to invest, and within that, for somebody who is looking at moving across the asset classes and churning, so there clearly I think hybrid funds make a lot of sense because this is the most tax efficient way to invest. So I think for the hybrid funds, let's look at large 4 buckets of hybrid funds, which are there in the market and also available on the Mirae Asset platform, right? So at one extreme end you have equity savings, where typically equity percentage is between, let's say, 25 to 40%.
Sure.
At the other extreme, you have aggressive hybrid, where typically equity percentage can be between, let's say, 65 to 75, 76%. So I think the positioning of these two funds is very clear. The most conservative investor can go to equity savings fund. The aggressive investor, while he wants equity exposure, but at the same time, he doesn't want 100% equity exposure.
Correct.
So there he has an aggressive hybrid fund.
Sure.
So that is very clear. I think the two interesting funds, which we have are this dynamic asset allocation funds. So one is, balance advantage fund, and second is multi-asset allocation. So on the balance advantage fund, again, it's equity taxation. So at any point in time, you need to have 65% equity, but the actual long equity can range from, let's say, 30% to 80%. So
Okay.
depending on,
Very
where markets are. And on the multi-asset allocation, the only difference between balance advantage and multi-asset is on the multi-asset, you also have exposure to gold and silver, which at least needs to be 10%. So I think for an investor, who is looking at more diversification, he can definitely look at multi-asset. Given the current, geopolitical dynamics, what I think Siddharth also alluded to, Gaurav also, alluded earlier. I think in that sense, while, one may or may not make a definitive call whether gold or silver will definitely do well the way they did last year, but I think from the diversification asset allocation point of view, one can have exposure to multi-asset allocation fund. So as I said, the positioning are quite different for all the 4 funds.
Sure. Thanks sort of Gaurav Harshad, for sharing your views on
Sure.
Asset allocation and hybrid funds and how investors can approach investing here. Just to summarize some of the things that we sort of discussed today, Gaurav touched on the outlook for equity markets. We remain very constructive on outlook for equities, considering what we've seen in 2025, both time and price correction. We believe 2026 will be a better year, in which case categories like large and mid, multi-cap and flexi-cap remain simple categories that investors can look at allocating, or investors can individually go to large, mid and small caps. You also covered that themes like banking and consumer look sort of very positive from long-term perspective, and infra is where reversion of mean can happen on once the government spending picks up. Basant sort of covered on the outlook for debt markets and how he believes low duration and short-term duration product are two best products to take participation of the debt markets. Siddharth, sort of covered on importance of gold and silver fund of funds, or separately gold and silver funds, and staggered way of investing in these two asset classes. For thematic products, he covered on new age consumption theme, banking and financial services theme, as well to look at. And for global allocations, considering that currently the limits are not there, investors can look at sort of a global product from the GIFT City side, which Mirae has launched for looking at investments. Harshad sort of gave his perspective on different products. So for conservative investors looking at hybrid products, equity savings remains a brilliant categories, and for aggressive investors, multi-asset remains a good category where they can get balanced exposure to commodities as well. What we would now want to do is to open the floor for questions. If you have any questions, please feel free to write it on the chat, and we'll be more than keen to answer all your questions. All our 4 panelists, Gaurav Mishra, Head of Equity, Basant Bafna, Head of Fixed Income, Siddharth Srivastav, Head of ETF Products, and Harshad, Head of Research, are here with me. We would be very happy to answer as many questions as possible from all of you. So please keep posting in your questions and we'll be happy to answer those questions. So let me sort of start with first couple of questions. The question from Mr. Manohar, that I have an aggressive hybrid fund. Is a balanced fund, has any fund required really? So basically, I know maybe his question is he's got an aggressive hybrid fund as part of his portfolio. Should he separately sort of invest in fixed income, equity, or an aggressive hybrid fund itself is good enough to give him participation to various asset classes?
I think this question is between fixed income and equity, then I don't think he needs to go in any other fund category. Aggressive hybrid fund, satisfies that requirement.
Sure. And in case he wants to sort of add, go to other asset classes, then sort of he can look at adding multi-asset products.
Multi-asset can be looked at. He can get exposure to both, gold and silver.
Sure. So we have a next question from Mr. Sujaj. And his question is, maybe Gaurav Mishra, if you're there, if you can help address, is what are the sectors you remain most bullish on? And can you share your perspective on which sectors you feel with a 3 to 5 year time frame can give better returns?
Yeah, I hope you can hear me.
Yeah.
Great.
Yeah, go on.
Yeah, sure. So in terms of sectors where we are or where I am, kind of comfortable with a slightly longer horizon, I will say that, considering that there's a huge India structural growth opportunity over the next, 3-5 years and a decade plus, for that kind of opportunity across the big sectors, whether it is, finance, BFS, NBFC, some of the non-lending, on one hand, and then the whole consumption cohort, right from discretionary, automobiles, and some select, niche models within that, the so-called models which have say differentiated growth because they may be platform driven, whether it is the quick commerce or some of those types of the beauty platforms, all of that. I think there's a host of sectors where the scope for value creation is pretty large. But earlier when we were speaking, I would want to caveat that at least in the short term, next 3-6 months, a lot of things are a bit dynamic in a state of flux. So there could be opportunities across a host of sectors and vice versa. What is looking promising might not turn out to be in the short term. But yes, for the particular question that we are thinking of opportunities more with the medium term, uh, consumption theme, the banking theme, etc. These are more the penetration of banking and credit, etc. These are more structural, and they would be sort of more preferred. Even on the infra capex side, I think there's a long way to go for Indian, infra per capita basis across, airports, highways, and every other thing which constitutes infra, including renewables, power, T&D, etc. I think there's still a lot of scope for growth there, but a lot of this has to be done properly, bottom up, keeping in mind that there can be some cyclicality in some of these other sectors.
Sure. Thanks, Gaurav, for your answer. Siddharth, maybe this is a question for you. What are the tax implications for investing in international ETFs?
Yeah, so I think, am I audible?
Yeah, Siddharth.
Yeah. So for short term, it is as per your marginal tax rate, and for long term, it is 12.5%. So obviously, based on taxation, it simply means that you have to hold it for a long term now.
Sure. And actually means I do long term actually benefits investors when they invest for long term, because that reduces sort of the volatility for investors. Question from Mr. Deepak is how to invest via Gift City. Maybe Mr. Deepak, you can just go through our site and you can get more details on how they can invest through the Gift City route. And maybe we can do a separate webinar to cover the Gift City route of investing as well. Harsha, this is a question for you. Maybe in the sort of current market scenario, where should investors invest through the lump sum route? So we covered that, some of the ways SIPs remain best way to sort of participate.
Yeah.
But if you want to invest in the lump sum manner at this moment, which category you believe can be the best one to say, sort of take advantage?
Sure. So I think clearly, go-to category for the lump sum right now can be one of the hybrid funds, depending on your risk appetite. But apart from that, also, let's say you want to invest in pure equity funds. So one can look at flexi cap, multi cap funds, from the lump sum point of view. Yeah.
Okay.
And sectoral, I think also it makes sense. Maybe you can be 3 months early, 4 months early, but then BFS and consumption, which we have our sectoral funds. So that can also make a lot of sense, if somebody wants to look at some sectoral funds.
Sure. Maybe the next question for you, Siddharth, is Vishal is sort of asking this question that how much percentage of the portfolio should be allocated to gold plus silver as part of the overall allocation? And maybe Harshad, you can also chip in with your views as well.
Yeah, I think it is very important to now not look at over allocating in both gold and silver. I think that time is gone now. So anything around 15% in both gold and silver combined in your overall asset allocation makes sense at these levels.
Sure.
Yeah, I think, as you said, 15%, or I would say the range of 12 to 15% is what one can look
Sure.
at.
The next question for Basant is from Mr. Ankit. Basant, we've already seen that RBI has cut rates 5 times. For 2026, how many more rate cuts do you think would sort of play out in 2026?
I think the bar for a rate cut is very high now. Inflation has to significantly undershoot expectations going forward, and the broad expectations are in the range of 4%. So, in case this undershoots massively, then we may see a final 25 basis points rate cut, but that is not the base case for now. The focus would be towards transmission of rate cuts that have already been undertaken by RBI. So the base case remains for a prolonged pause for the next year, 2026.
Sure. Maybe a couple of questions from Mr. Om and Mr. Deepak is, Siddharth, if you can sort of cover it. People are a lot of keen to invest in platinum or copper. Maybe that could be because gold and silver have sort of done well. Is there any way, a way investors can access investing through some of these products?
So obviously there is demand for a lot of these metals because not only just gold and silver, platinum has also done really well, so as other metals. But sadly, at least on the passive route, only gold and silver is allowed by SEBI. But even our sister concerns, for example, in US we have disruptive materials ETF, and we have ETFs on other commodities as well. So if you have and if you can invest via LRS route, you can find these options in global markets, even through our sister concerns. So maybe you can have a look at that.
Sure. Next question from Mr. Ankit Raman, and we'll just take last 2 questions. I know the investor is saying he's got an investment in Mirae large and mid cap fund by doing an SIP for the last 5 years. So thank you, sir, for giving in your faith in our fund for the last 5 years. He would like to know if he needs to diversify his portfolio, considering the outlook in the market and the sort of outlook for that fund. Maybe Gaurav, if you can address that question, and maybe Harshad, you can add to anything on that one as well.
No, I think that's a good fund. Good managers are running it. I think the future also looks pretty, or in fact, very bright. and it makes sense to remain invested in that and with that SIP, etc. Maybe at some stage, if there's a very sharp or a prolonged correction in the small cap, one could, as part of allocation, look to add maybe 10-15% of the corpus, one has in mind into a into a small cap fund that way to get exposure into that sector. But yeah, otherwise this is a good fund to remain invested with.
Sure. Thanks, Gaurav.
So I think I would agree with what Gaurav said.
Yeah. Maybe last question that we will sort of take is from Mr. Prashant. So Arshad, I think maybe you sort of addressed it, but Mr. Prashant says he's an aggressive investor and he wants to know what should be the appropriate allocation mix that he could look at for investing in sort of the four asset classes we discussed, and what could be the better way to look at investments.
No, I think, yeah, if he already, if he is an aggressive investor, so, so from that point of view, one can limit the debt allocation to the lowest, or one can also have a zero debt allocation depending on, his age profile and risk appetite. But I think so equities, one can have at least 70-75%, and within that, as I said, 25-25 can be to mid cap and small cap, and the rest can be to large cap. See, between large, mid, and small, it's more like pyramid, right? I mean, large cap is a base where you want to have a stability, as you saw, in 2025, and then mid and small, which kind of creates alpha to your overall returns. Right now, I think, as Siddharth said, I think allocation to gold and silver can be limited to maybe not more than 12-13%, and the rest. So debt maybe net debt can be less than 15%, 10%, or can be zero also. And within equities, you can have large 50 and 25, mid and small.
Sure. Yeah. So thanks, Arshad, for addressing that question, and thanks everyone for joining us today for this webinar. In this webinar, we have tried to decipher outlook on all the asset classes, which is equities, fixed income, commodities through gold and silver and international markets. We've also tried to give you some categories which we believe would be able to perform better in 2026. We would be very happy to hear your feedback on this webinar and what can we do to make this sort of sessions more interactive and beneficial for partners and investors. So do please keep sharing your feedback to us, which will help us improve. And we are at the start of the year. Hopefully, the investment outlook for 2026 remains positive. So happy investing to all of you, and have a great year ahead, a year of success, happiness, and good health. With that, we would like to end today's webinar. So thank you, everyone.